Morning, everybody. Well, thank you once again for getting yourselves up out of bed so early this morning to make your way to one of our seminars that we run every 6 months. This is a slightly different one to the normal seminars that we've run, because we've made this a little bit more specialist and just aimed it at our clients that use Sage. As an accounting practice, we have to work with lots of bits of software, accounting software, and we've got clients that use specialist programs that are just designed for their industry and all sorts of weird and wonderful things that people have got for historical reasons. But by far and away, the most widely used piece of accounting software that we work with, and indeed for small and medium-sized businesses generally, is of course Sage. Thanks to wonderful marketing back in the 80s, they've sort of become industry standard, and almost hard for small businesses to argue with and use other packages. I've worked with Sage since 1989. And what we've seen is that in the last 2 or 3 years, there have been more changes within the accounting software world, if you like, than perhaps there have been for sort of 10, 15 years before that. Hence the reason for the seminar today. Now, I usually start all of these seminars with just a quick overview of how things are generally out there, and it would be reasonably fair to say that at the moment, particularly for owner-managers, Britain's booming. We've got the fastest growing economy in the EU at the moment. We are seeing as well that owner-managed businesses are making more profit now than at any time in the last 7 years since the credit crunch and the recession that followed. And that's backed up across the country really by increased tax revenues flowing into the Treasury. That's had a knock-on effect to the sort of the financial world really, that good management accounts and bookkeepers have become a little bit thin on the ground over the last couple of years or so. So for any business, you have a finance department, even if that department only consists of one person. And there's 4 different aspects to the work that needs to be done within that department. The first one is what we would call the basic inputting. So these are your purchase invoices, your sales invoices, all your sort of basic back transactions. If you get a really good admin person who may not even understand the difference between a debit and a credit, and a good bit of accounting software, then that person can be trained up to do that sort of basic inputting within the business. It would equate to about 70% of the work that is done within the finance realm of your business. But what we're increasingly starting to see is that some of that work can be automated by possibly bank feeds that come through straight into your accounting software, or even other bits of programs that potentially read purchase invoices and post them straight onto your system. And we're going to show some of those things a little bit later. So potentially the volume of work that is actually required on that basic inputting side is going to reduce a little bit over the next few years. The second aspect of your finance team is what we call the basic controls. So this is the sort of stuff like the bank reconciliation, the most important control in the accounting system, making sure that what you've posted agrees to what's coming through on the bank statement. The second one would be, or the second area would be just stuff like reviewing your debtors and your creditors to make sure they're right, doing things like wages journals, right the way through to preparing the VAT return. That then produces, if you do all of those things, that will produce a trial balance that ought to be good enough for us to do the end of year accounts on. Now that will require some bookkeeping expertise, and because there's a bit more of an understanding of the accounting that's going on that is required within that within those controls. And we would estimate that sort of equates to about 20% of the work that you do. So 90% is down to those first two things, inputting and basic controls. And if you do those things well, as I said, we will get what we need to do your end of year accounts. The VAT man will be happy that all your records are reliable, etc. The third aspect is what we always refer to as advanced controls. So these are things that are necessary if you're going to get accurate monthly management accounts that tell you how well your business is performing. And this is stuff like, depends on what business you're in, and often it's very specific to your business. But if you've got stock levels that go up and down, if you have work in progress, sometimes we've got clients that do maintenance agreements where they're actually invoicing in advance. And if you're not doing journal entries to account for these things, then actually the management figures that come off at the end of the month are complete nonsense, because there can be some massive swings in the accuracy of the figures without accounting for that properly. That would require a good bookkeeper to do that sort of stuff, or a sort of what we might call an okay management accountant, somebody that knows what they're doing on that side of things. I'd guess that accounts for about 5% of the work, but it often requires input from the owner. And I know that there's a few bookkeepers in the room who are always quite frustrated that they can't produce accurate management accounts because they can't get the information out of the owner-manager of the business about what that work in progress or stock or whatever else is required actually is. Which always seems a bit of a shame to me that we've put all that work into this accounting system and then they're not actually getting accurate figures that you can base decisions on. But if you do all those things, you'll get those accurate management accounts. So what then? Well, the last bit, perhaps some would argue the most important bit, is the interpretation of those figures. At most, that equates to 5% of the work. That might even be a bit of an overestimate. I mean, I've got clients, quite a few of them, that would spend 2 or 3 hours a month on the interpretation side of it. Once the figures come through, just looking at those, that would require a good management accountant to do that interpretation, possibly some input from us as the accountants, or an owner who understands accounts. Because owners understand their business, but they don't necessarily understand what the figures that are coming off the accounting system are actually telling them about their business. Often it's only by asking questions about those numbers and doing what I would call a turning over stones exercise that you start to find out stuff that's happening in your business that will then enable you to make some changes. What's the point of all of this? Well, first thing is it will start to highlight trends in your business, whether they are good, in which case you might want to build on aspects of your business that are performing well, or negative, in which case you probably need to do something about it. You can investigate anomalies, so a cost that is much higher than you would have expected. You know, is that genuine cost? Have you been invoiced twice and accidentally approved the same invoice twice? You know, is there something untoward happening within your business? And I always say any of the cases of fraud that have occurred within our client base that we've had to investigate, the common denominator amongst every single one of the clients was that the owner manager of the business did not review the monthly management accounts, because we think that if they did, they would have identified what was going on much earlier. So on its own, one very, very good reason for getting those figures. It means you don't get any surprises. You're not finding out that the business isn't doing quite so well as you thought it was 4 months later when the bank balance is got a big problem with it. You can start to predict problems in that area. It'll help you make decisions as well. There might be decisions to reward people within your business that are performing really, really well that you want to hang on to. Might be help you identify people that might need a little bit of a G-up. might help you to make cuts in overheads or areas of your business that are performing poorly. And once you've made decisions, hopefully assess the results of those decisions. And lastly, it should help you to predict cash flow problems.